Welcome to today's Finance in 15, where we'll explore latest economic trends, market movements, and investment strategies for 2025. I'm Steven, and I'm joined here today with Josh and Melissa Stein. Thank you both for being here.
Hi, Steven.
Thanks, Steven.
Absolutely. So let's talk about big picture. The economy is facing multiple challenges: rising inflation, interest rates concerns, and global uncertainties. Josh, what is your take on the current economic landscape?
Delicate. We got a lot going on. We have interest rates that are stable, but certainly not coming down, at least right now. We have the concern that inflation could potentially go the opposite way. We have global trade wars,
Political turmoil,
wars. There's a lot going on. And let's just also say, that was the negative stuff, because I think that's what concerns people.
Yeah.
There are a lot of silver linings. We can talk about some of those things.
It is a perfect recipe, though, for volatility, right?
Absolutely.
The markets don't like uncertainty. We've always said that. And certainly there's a lot of uncertainty right now, which is putting a lot of our clients and investors on edge as well.
Absolutely. Yeah. So it's a delicate marketplace right now. The stock market, as we've seen to start the year, has had a bit of a pullback. I think the S&P is down about 3% year to date. What's the NASDAQ down? A little over 7? It hit correction territory at one point, right?
Although probably not as bad as a lot of investors are feeling just from the headlines, right? When, down 3%, no one likes to be down, but I think sometimes the way the media frames things, they actually make it sound a lot worse than it is. And then it's hard for people to digest that, and they start panicking and making poor decisions.
And contextually, I wish I actually brought the data to this discussion, but a 3% or even a 10% market pullback is far from abnormal. In fact, quite the opposite. It's extremely normal. And in fact, a 3 to 5% pullback is
even a 10% pullback is not abnormal.
No,
they happen a lot.
They happen frequently.
Right.
Roughly every 18 months, there's a 10% or more correction.
There we go.
S&P.
Right. And quite frankly, given where the S&P's been from a growth standpoint, just looking at that year to date, year over year, even over the last 10 years, and specifically the NASDAQ, there's a lot of growth there and room for pullback. I don't think it's unexpected at this point that we would be seeing a little bit of that.
And I would add in there that, the job markets are still remaining resilient. Wages are still growing.
Yeah.
And consumer spending, although it is slowing, it's still strong. So just a little bit additions to add there. But would you guys say we're heading toward a soft landing, or should we brace for more volatility?
I think we're in a range of market trading here where we will see continued volatility. I'm not convinced that doesn't mean that a soft landing still doesn't continue. It almost feels like the boy who cried wolf as far as the recession word goes. How long have we been saying we're going to potentially be in a recession?
Probably 2 years.
And we haven't officially thus far since COVID been in a recession. That being said, I don't think that volatility goes away anytime soon because, as Melissa had mentioned a moment ago, there's a lot of uncertainty, and I would submit that the stock market actually dislikes uncertainty more than negativity. Negativity can be priced in. Negativity can be valued once there's an actual data point. When the markets don't know something, it tends to go to the worst and the worst scenario, which also likely is usually not reality, right? And that's where then markets will come back once the data is actually substantiated.
Yeah.
So we are right smack dab in this place where there's so much uncertainty because we don't know what will happen with things like political policy, tariffs, these types of
taxes. Anything really.
And until there's some resolution, even if it's bad resolution, until there's some resolution, we're going to see volatility.
But on that note, there's always a lot of focus on the market, the S&P 500, equities.
Sure.
But a lot of our clients forget that we also own another investment asset class, which is bonds. And there's a reason that we own those bonds, and they're for times like this. And I think this probably relates back to some of the silver linings that you're talking about.
Indeed, absolutely. And it's easy to forget that because going back to 2022, a lot of the pain that investors felt was not only the stock market being down and the stocks that they own, but this was one time where bonds were correlated to the same degree as stocks, and the bonds were down.
Which means they went in the same direction.
Right.
Stocks and bonds went down, where that's not happening right now.
Well, in fact, it's the opposite. So year to date, bonds are positive. Not by much, but they are. which means if you're in a balanced portfolio where you own some stocks and some bonds, even if your stocks are down, your bonds are actually up, which really counterbalances a lot of that feel. So when you pop on the news and you see the S&P 500 down, well, you're not really invested in the S&P 500. So that's going to help curb some of that
Most of our
volatility.
clients have between 20 and 50% bonds in their portfolios. So there should be just as much focus on that discussion as there is on the stocks. But you don't see anybody talking about the bond market returns on TV. And I guess it doesn't really make headlines. So like if we look at a lot of our portfolios are actually flat year to date, maybe a little bit down, or even, I mean, there may be some that are positive and up a little bit. So clients might be surprised to hear that. And you know, we've had a couple clients call in and say, hey, I'm afraid to look at my accounts. I'm like, actually, you haven't lost any money. And it's, you know, they've been relieved. So I think it's really just understanding always, too, that this is still, we have to always take a long-term perspective. Even if stocks go down, over time, they tend to go up more than they go down. So we're still going to make money on that piece of your portfolio. Even if you're retired, you know, sometimes when you're retired, you say, oh, I don't have time to, quote, recover. Yes, you do, because you're not using your whole portfolio at one time. Right. We're not liquidating the entire portfolio to fund your retirement and having to liquidate things when they're down. So there's always pieces of the portfolio that are generally, you know, going to be able to be liquidated to fund your monthly income. So those are some things that we look at, and the reasons we've structured our portfolios the way we have is to protect our clients' income and still be able to achieve growth so that they don't outlive their income. And those strategies are the ones that we use to employ our investment decisions.
And for those investors who may have more of an appetite for risk, there are potential buying opportunities. And I'm certainly not saying that this is the bottom, and quite frankly, nobody knows that. But anytime that you can buy some good quality stocks that are arguably on sale, that can lead to potential opportunities. So that's another silver lining is being able to purchase stocks that were that are cheaper today than they were a few months ago.
Yeah, we always, you know, it's the same old adage: buy low, sell high. What's Warren Buffett's most famous one? It's time in the market, not timing the market. I mean those statements are always true. And you know, being invested right now, even with volatility, I mean, over the long term, that really shakes out. And you know, historically, we've seen clients gain a lot of benefit from staying invested in stocks during times like this. So sure, there's a lot of uncertainty. Yes, there's a lot of, I think, political instability. A lot of things seem really uncertain. But you know, at the end of the day, the stock market goes up when companies are in a position to make more money and can be more profitable. So really what we need to focus on is, can companies in this environment be more profitable? And I think the jury's out on that. Yeah. So, I mean, I would say we're cautiously optimistic. We own stocks and bonds and other asset classes and use things to mitigate stock risk other than bonds when we need to. And right now, we feel like our portfolios are doing a pretty good job of holding their ground. We think we're well positioned to kind of handle whatever comes over the next, I don't know how many months are we into the year, 3 months already. So the next 9 months. And I mean, we're going to have to watch and see how things continue to evolve and unravel. And I think we'll get more clarity over the coming months. But just to remind everybody, I mean, we're making changes to our portfolios on your behalf all the time. And we make those changes when data becomes clear. And right now, you know, not all of the data is clear. So we might need to wait a little bit to make some decisions, but sometimes that's when it makes the most sense.
And just kind of reiterate that, you know, for, you know, the bond markets and stuff, we're finally seeing some attractive yields, rate stabilization, and, you know, long-term bonds can provide some steady returns. So, you know, definitely using those to help manage risk.
Sure. I mean, people forget about yield. I mean, what's the yield on the ag's like what? Right now, do you have any idea what the
4%?
Yeah, it's about 4%. But I mean, some of our bond portfolios I know that we've constructed are probably closer to 5 or 6. So I mean, even if you're not getting a lot of appreciation there, you're still getting income off those portfolios at a time like this, and that's another thing to take into account. So
in times of volatility, things like income from bonds, dividends from your stocks. We even have some more sophisticated covered call stock option, which is a very conservative approach to even generating income from your stocks. All of those things can help because all the income that comes in, whether it's from dividends, stock options, or interest on your bonds, helps mitigate some of that market volatility. So those are all tools that we are using right now that certainly in this economic environment can help just kind of curb some of that risk.
I mean, with prudent investment planning and good financial planning, anyone's retirement strategy should be able to withstand periods of volatility like this. I mean, that's the entire point of doing what we do. And we expect and know that for every 10 years in the market, there's going to be 2 or 3 that aren't great. I mean, this is just part of being an investor and part of being in a normal cycle. The cycle isn't always up. If it was, then everybody would just do that.
Yeah. It's easy to lose track of that.
It is, and I'm just reminding everybody. I mean, I also understand the emotionality of it, right? You know, nobody likes to see their money go down. I mean, we don't like to see our money go down, but we also know that it's going to go back up. We also know that there are strategies we can employ to take advantage of that, and that's what we do, systematically and repeatedly implement those strategies without emotion to help our clients meet their goals. And we just like to remind everybody too that we're here if you're having doubts. Like, you can give us a call, you can send us an email. I know some clients say like, oh, I feel silly doing that. Don't. I mean, this is what we're here for. And if you have specific questions regarding your portfolios, we're all here to help as well.
Speaking of those portfolio adjustments, we just recently had our Q1 rebalance. Any thoughts on the adjustments given the current macro environment?
Yeah, the theme that has continued through the last several rebalances was a big theme in this rebalance, and a lot of this is just really focusing on quality. So although we are kind of at target with regards to the amount of stocks that we own, we've been really focusing on making sure that we own the good ones. What makes that good, that's a little bit more complicated, and it doesn't necessarily mean that every good stock doesn't go down in value, but there is some importance to say we want to own the stocks that have more of this tilt towards quality, because that can certainly help in uncertain times. The other thing that we're looking at is we've trimmed a fair amount of international, just with a lot of the kind of global concerns that are going on right now, in particular tariffs and wars. We've been significantly underweight international for a long time. We're even more underweight international, just because we think at this point in time, there's just more
The opportunities
security.
aren't as great there. I mean, they're just not. We're given like the risk, looking at the reward versus.
Yeah,
the
it's
risk,
quality.
yeah.
You know, we want to own good stuff without having to time the market, because there won't be a time, at least generally, where we're just selling all stocks, right? I mean, that's not what we do, because anytime you try to time the market, you got to be right twice. You have to be right when you sell, and then you have to be right when you get back in, and that's virtually impossible long term, right? You might get lucky once or twice, but in the long run, there's too many opportunities to be wrong. And so instead of trying to be right and ultimately being wrong, we take the approach of manage the downside. And sometimes it's not about how much money you make, it's about how much money you don't lose. And the less you lose, the less you really need to recover. That's important.
Yeah.
And those are a lot of the things we take into consideration.
Well, and risk management is one of the biggest things we focus on in constructing and making portfolio changes. If we do X, how will that impact the risk in the portfolio versus the potential return that we're going to get? So it's really about balancing those things.
Let's wrap up with some advice for investors navigating this market. What's your top recommendation right now?
I think the biggest thing that our clients in particular can do is stay invested, but make sure you're being diversified, and that's really what we do for you. Now is a very important time to make sure that you're not taking risk in the wrong places, and that can be difficult, but that's what our investment committee and specifically what we do here for your portfolios on a regular basis. We're looking at risk from top down, so we're not trying to chase performance as much as we're actually trying to chase risk mitigation. And that's a really unique way of looking at how to manage money, because a lot of other firms are really trying to get the most performance over time. And not to say that we don't want good performance, we do. But we want to make sure that relative to the risk that our clients are willing to take, that the performance that they get is commensurate with that first. So being diversified and really just not panicking and making irrational investing decisions.
Or getting caught up in hype, because I find now it's like Bitcoin and, Nvidia, and like we see a headline and we just want to react to it. Like, well, do I own that or should I buy that? I'm going to do it right now. And sometimes when things are being hyped up, that's actually the worst time to buy something or to do something. And those are certainly things we want our clients to run by us. If you have those thoughts, run it by us. Let's talk about it. Let's see if it makes sense for you. But certainly I would say like getting caught up in media hype and other things isn't necessarily, the best thing to do either. And just kind of reading random headlines and thinking, oh geez, like this is now going to impact me. I mean, there's a million headlines, negative headlines or scary headlines out there. I think just being educated and trying to understand before we react emotionally. I mean, that's what we try to do, and not letting one thing think that you should derail your whole investment strategy because of it. That's kind of the biggest threat I see, like recently for clients. It's
No
just
question.
thinking like, gee, if I don't do this, or now what is this going to mean for me, right?
And that goes back to what I think is the other important thing for investors to consider right now, which is perspective. And perspective can be really, really hard because money is so emotional, and we tend to remember the market highs and the market lows, but not necessarily everything in between. And if you take perspective into consideration, go back and rewind time. I don't care how far you go back 10, 20, 30, 50 years, go back to the 1920s and look at the probability of the S&P 500 or the stock markets in general of generating positive returns over time. They're in your favor. And that perspective, clients will ask us a lot like, hey, are you concerned right now about what's going on? And my reply is always, well, I'm always concerned. I mean, there's always something that we have to take into consideration. Mm-hmm. And then the question becomes, are the events happening right now any different as far as meaningful impact to future likelihood or future probability of you having success than what's happened over the last 100 years? I mean, we've seen world wars, we've seen massive financial
many different
crises.
presidencies, some extreme, some not.
We've seen a lot of crazy stuff.
We have.
Is what's happening today materially different?
Well, it feels
Impact-wise,
different, but
it always feels different.
Yeah, it always feels different, but it doesn't necessarily mean that.
And our philosophy is, well, it's probably not. I mean, we got a lot of back-tested historical data that has shown a lot of resiliency to a lot of things. And feeling different doesn't necessarily mean that big picture-wise it is different. And that's the perspective that I think is just helpful to remember. Yeah. And that's where we want to partner with our clients to make sure that they feel comfortable sleeping well at night, knowing that, yeah, there's going to be some volatility. You're going to open up your quarterly statement, and it's possible that your account might not be at the exact place that it was the quarter before. But let's remember the perspective, and let's remember why we are doing what we're doing. And I think that really helps significantly.
So staying patient, investing wisely, and don't overreact to short-term headlines is kind of my key takeaways from that. Wouldn't you agree?
I would.
Absolutely.
That's exactly right, Stephen.
Sweet. Well, that's all the time that we have for today. Thank you both for sharing your experience as always. And to our audience, stay informed and keep your financial goals in focus.